Good afternoon, everybody, and welcome to the latest event in our series of Professional Advisor Working Lunches. I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for the next hour. I'm joined today by Toby Ross, Investment Manager at Baillie Gifford, who would argue why investors need to think more broadly about dividend sustainability than they may have done in the past. He'll also explore whether there's a trade-off between sustainability and investment objectives. After I finish up my introduction and housekeeping, Toby will set out his thoughts in a 10 to 15-minute presentation. Toby and myself will then have a discussion before we bring in questions from you all at home in an audience Q&A session at the end. Do feel free to put any and all of your questions to Toby using the chat function, which you'll find to the right of your screen at the bottom. If you wish to remain anonymous, then simply select my name from a drop-down list in the chat box before you type your message, so only I can see it. Now, for the housekeeping, your microphones and cameras are currently switched off, and we'll be most grateful if you could keep them that way. It will ensure there's no background noise, so the two of us can be heard more clearly. I should also inform you that this session is being recorded, and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to recording of the session, which, as I said, would arrive in your inboxes tomorrow. And now, for that coveted CPD, here are today's four learning objectives. Develop an understanding of the importance of considering sustainability when building portfolios for a client's long-term income needs. Understand the building blocks of resilience in an equity income portfolio. Review where some of those interesting income investment opportunities over the next decade are likely to be, and understand the potential trade-off between sustainability and investment objectives, if there is any. Okay, so that's the housekeeping out of the way. Let's move on to our main event, and let me hand you over to Baillie Gifford Investment Manager, Toby Ross. Good afternoon, Toby. How are you?
I'm very well, Tom, and hello everyone from a surprisingly sunny Edinburgh today.
Yeah, not so much down here.
Sorry, don't mean to gloat. It's rare that we get the chance to gloat from up here. Shall I kick off? Well,
yeah, get going. Go for
it. Thanks very much, everybody, for your time today and giving us the opportunity to talk to you. We're going to be talking about the Responsible Global Equity Income Fund, which we launched just under 3 years ago. So it's just coming up for its 3-year track record now. And we launched this fund because we thought that income investors who had a need for a responsible strategy were being very poorly served at the time. There really weren't very many options out there. And I remember sitting in meetings where people told me with a straight face that income investor, the best dividends came from the worst companies. And if an investor wanted to invest for income, then you had to maintain the full opportunity set. You had to be able to invest in tobacco and big oils and things like that. And that just didn't seem right to us. And particularly if you take a long-term approach to income investing. And we knew that there was a need for a different approach to income investing for some of our charity and endowment clients who were kind of coming to us saying, look, we want to be able to invest for income and growth, but we want to know we're doing so in a responsible and sustainable manner. So we developed this strategy in conjunction with them and seeded by 2 of our charity clients with £50 million 3 years ago. And the fund's now up to just under £300 million today. So I'll just share my screen now. So what is, in a nutshell, what is the fund and what is different and unusual about this fund? I think I often say that a good way to think about what we're trying to do on the Global Income Growth Team is a Baillie Gifford approach to income investing. So the hallmarks of our strategy are, firstly, that we take a growth mindset to everything we do. We think that if you're investing for 5 or 10 years for income, then you're much better. You need to think really hard about where growth is going to come from over that time horizon. We get a huge advantage from being within the Baillie Gifford fold of strategies. So nearly half the stocks that we invest in are owned by another Baillie Gifford strategy. So we get this great flow of ideas of growth companies, some of which also pay dividends. So that growth heritage and growth approach is a really important building block and I think makes us quite different from many other equity income managers. Secondly, our time horizon. we take a really long-term perspective to everything we do. You can see here that the turnover level on the fund's around 8%. So we've got a sort of 10-year plus time horizon. We think that's important because many income clients actually also have a really long time horizon. If they're an individual who's investing for their retirement income, or they are a charity or endowment, often these people have a 10 to 15 year time horizon. They're thinking about what's going to provide me with income and growth over a long period. We share that, and that's kind of built into our thinking about investment, the types of company we look for. Finally, we're sustainability driven, and there's a great deal of expertise sitting within the strategy about how to invest responsibly. We've got a dedicated specialist, Gavin Grant, who's got over 30 years of experience in the field of responsible investing, and a really interesting CV and background there. And he's got a key role in our responsible strategy, which I'll talk about more a little bit later on. So the sustainable, the focus on sustainable investing is built very deeply into the strategy. We've got two objectives for our clients. Firstly, to deliver a sustainable stream of income over the long term. And secondly, to deliver real growth in both income and capital. And those two objectives are equally important to us over time. And in launching the fund and managing it, we've been building very much on our successful track record of income growth investing at Baillie Gifford. You may be aware that the Global Income Growth Fund that we also manage has been around for 11 years now and has got one of the best track records in the sector. So we've learned a lot about how to invest for long-term income and growth through our experience of that strategy. So that's the fund in a nutshell. What do we believe in though? What are our core beliefs around investment? When I'm asked to explain our philosophy, I tend to turn to this slide and explain that what we're investing for is long-term income, not short-term yield. It's, I think one of the big mistakes that people make often when they're investing for income is that they think that the best income investments are the ones that offer the highest, the greatest amount of income in the near term. And what you see time and time again is that gets it backwards. The best income investments are companies that can not just deliver income today, but deliver really strong earnings growth over the next 5 or 10 years and pay dividends as they grow. Those companies are going to be companies which have cash generative business models, very sustainable business models, and they're going to deliver much better outcomes to investors. And a good example that we've got here is two income stocks over the last decade. So one is Microsoft, which we've owned for many of our clients for a decade. And the other is RWE, the German coal-burning utility. If you go back 10 years, RWE looked like a much more obvious income stock. It had a yield of over 7% and was considered a dividend stalwart. But it had some big sustainability challenges in its business. It needed to pivot away from burning coal towards renewables, and that was really expensive. It was subject to regulation that was outside its control. It had low margins that were really volatile. And so what you saw over the last decade is the dividend has been cut repeatedly. It's been a terrible stock for an income investor to own. By contrast, Microsoft, which is the sort of business we tend to prefer, and as I say, it's one that we've owned for a long time, started with a much, much lower yield. But because it's delivered steady growth over a long period, it's actually delivered twice as much income over the last decade as RWE has. And because it's a growth company, it's also delivered far better capital growth as well. We think that when you're investing for long-term income rather than short-term yield, it's obvious that the type of business you should be looking for is not the stock that's got the highest yield today, often with a big sustainability challenge built into its business model. It's businesses like Microsoft. It's capital, cash generative, growth businesses that pay dividends as they grow. So what we're doing as a team is entirely focused on long-term income rather than short-term yield. And all of our research process, which we can talk about more, is all geared towards how do we find the Microsofts of tomorrow, and how do we avoid companies like RWE or Shell or BP. Now, I mentioned earlier that sustainability is built very much into the heart of the strategy. What we're trying to deliver isn't the highest income stream we can, it's a sustainable income stream that delivers strong growth over time. But I think a question that you as advisors should have in your mind whenever anyone says, oh, I invest responsibly or sustainably, is, well, what do you mean by responsible investing? That can mean many different things to different people. So we try and be very clear about what we mean by responsible investing. To us, it comes down to three things, which we've shown on the slide. Firstly, finding companies where the growth opportunity is genuinely sustainable. That's the core of our team's research effort. We put a big focus on trying to gather insights from a very diverse range of sources. That includes our colleagues on other strategies here, academic experts, industry sources, and we try and triangulate lots of different viewpoints to help us build a view on long-term growth. But a key part of that is also thinking hard about the sustainability of each business model. And the input of our sustainability team and Gavin Grant, our ESG specialist, is really important there. Every time we consider a company, Gavin will write a detailed sustainability analysis using our framework that helps us assess the opportunity and the risks of each investment case on their own merits. The second part of the process is ensuring high standards. We know that responsible investors care about the basic quality of the investments that the companies they're investing in. They don't want to be associated in businesses that are going to expose them to significant risk. Because of that, Gavin has the right of veto over this portfolio as a result of his research. And I can talk later, if you like, about some of the times that has been exercised. To provide a basic safeguard for our clients, we also apply exclusions based on the principles of the UN Global Compact and harmful products. So that covers how we decide the types of stock we're looking for and how we decide what doesn't make the grade for our strategy. The third component is, though, about how we behave with what we do own. So often people think about investing in responsible investing in a negative way. Here's how we decide what not to own. But just as important is, how do you behave once you're an owner of stocks? As I said earlier, we've got a very long-term approach to investment, and that puts us in a very strong position to engage constructively with the boards and management teams that we invest alongside. For each company we invest in, so each year we set out a detailed engagement plan, setting out what our priorities as a strategy are. And for each company, we try and be very clear about what should our engagement priority with this company be. And then we're very patient in terms of engaging with companies to try and deliver the change that we want to see. The final point I'll just talk about briefly is the team that sits behind the strategy. So the team is shown here on the right-hand side. The strategy is managed by myself and James Dow, who are the portfolio managers, and we've worked alongside each other for a decade now. And we're supported by 4 dedicated analysts, who are the 4 you can see directly beneath us here. And they come from a very wide range of backgrounds. And then we're supported by 3 specialists who help us in particular areas. So Gavin is our sustainability specialist. Hattie Oliver's our investigative researcher, who's got a journalistic background. So she goes and talks to management to former employees of a company's customers, suppliers, to try and build a rounded picture of what's going on underneath the surface. And then Rio contributes to our strategy from China. So as well as the broader Baillie Gifford research platform, there's a very well-resourced team finding exciting growth ideas for this strategy and then able to test whether they meet our high standards. So I'll stop there and pass it back to Tom, but yeah, very much look forward to taking your questions in the rest of this session.
Brilliant, thanks for that, Toby. So first up for me, you've got the aim of delivering sustainable growth. How did that work out in 2020? Because obviously it was a very volatile year for many reasons.
Yeah, it was very volatile, and I think particularly if you were a UK-based income investor, you'll know as well as I do that dividends in the UK market were down by something like 40% last year. And I remember it felt like every time you turned on your computer in the first half of last year, there was another announcement about another mega cap that had just suspended its dividends. So it was exciting times. What has been, I think, remarkable and, if I'm honest, very pleasing to us has been just how resilient our strategy was during that stress test. You can see here on the left-hand side that last year, our distribution to clients was actually up very slightly. despite all of the dividend cuts that you were seeing around the marketplace. And I think that shows what we mean by trying to deliver a sustainable income stream. Now, there are a couple of different inputs to that and into how we were able to deliver that. One is just very simply the global opportunity set. You know, if we'd been restricted to the UK market, I think we'd have found it very difficult to deliver that income performance. But we weren't. We were able to invest in a huge range of different types of companies. And we've shown here some of the companies that were our largest holdings when we went into the pandemic 18 months ago. And you can see that 9 out of 10 of them grew their dividends last year. That is partly because we just have this richer opportunity set. It's also partly, though, about the type of business that we look to invest in. We put a lot of effort into stress testing our companies. We're trying to own resilient through cycle companies that can maintain their dividends even when the going is tough. And that work to stress test the dependability of our dividends really paid off during 2020. And you can see, you know, companies like Roche, Procter & Gamble, Sonic Healthcare, you know, TSMC, these companies were never at risk of having to cut their dividends. So they were just in a much stronger place. The final observation I'd just make on having invested through 2020 and what we've learned from that is just the importance of growth. That the companies that ended up rebasing their dividends and not putting them back up were ones where there's a fundamental growth question. The boards just didn't have confidence that the market was going to come back to them when the pandemic, you know, sorted itself out. And that's, you know, companies like Shell or, you know, many others. Those are the ones where you saw the resets. What we observed was one thing that really helped our income stream is having lots of companies that kept growing very strongly through the pandemic, where management had a lot of confidence on the long-term growth drivers. So you can see here, TSMC, they put the dividend up by 11% last year, which was very helpful to us. And they did that because the demand for their high-end semiconductors remained as buoyant as ever. And in fact, the move to cloud computing accelerated that demand. So one message we took from that is, gosh, it's really important to be invested in genuine growth businesses because they're going to be able to help provide a counterpoint when things get more difficult. And also, you know, that growth is going to be really helpful over time.
Mm. And Baillie Gifford, you know, you're long-term investors. Was there any divestment decisions you had to make during 2020 because it was a tough year? Did you have to cut the long-term on anything?
There were, and the way we made some of those decisions was we looked through all of our holdings and said, look, are there businesses where our conviction in the long-term growth case is just not what it was? And equally, are there new opportunities where our conviction is higher than it is in those names? And there were a handful of names that fell into that category. One that stands out is a couple of European banks that we had owned small holdings in. And we took the view in Q1 last year, look, the long-term earnings outlook of these businesses is just lower than we had previously thought. And it's very unlikely that they're going to be able to maintain that regulators will let them maintain their dividends through a prolonged crisis. But we replaced those with companies, you know, like T. Rowe Price, the American Asset Manager, or Hargreaves Lansdown, or Medtronic, the medical devices businesses, companies which we felt had their destinies within their control and were a very good fit for a strategy, and where the growth, you know, even if there was a short-term earnings impact, our confidence in the long-term case was very strong.
You've mentioned the balance between growth and income a lot. And I think it was, you know, the two pillars of the fund. I think you said in the presentation, you know, long-term growth and income. What conversations do you have behind the scenes to make sure you find that balance? And, you know, what do you have to give up to find one or the other, and vice versa?
That's a really good question, because I think there's always a trade-off you've got in your mind around trying to find businesses that are going to deliver both of your clients' objectives. In one sense, if you were to just emphasize growth and forget about the income objective, there's lots of exciting businesses that are never going to deliver an interesting income stream out there that you could be drawn to. And our colleagues are very good at finding them here at Baillie Gifford. But equally, we think it's really dangerous to get drawn towards high-yielding companies where the long-term growth outlook is poor. So we're constantly assessing every stock against both of those, and actually also the sustainability of the business model. So it's both growth, the income potential on a 10-year view, and also the sustainability of the business model over a long-term view. And we're, as a team, constantly debating that. Is the growth opportunity at Experian more exciting than at Edenred? How excited should we be about the 5 or 10-year growth outlook at Cisco versus Apple or Amadeus IT or Anta Sports, the Chinese sportswear business? We're constantly doing those trade-offs. To bring it to life a bit, why don't I share this slide? So this shows our entire portfolio at the end of June. And what you can see along the bottom is the yield, the stock divided by yield buckets. And then every company is shown here. The key thing I'd point out is most of the portfolio is on the left-hand side of this distribution, stocks that are giving us some income today, but where we're really excited about the long-term growth. And we tend to have, I think, very little and probably much less than most of our peers in companies on the right-hand end of this skew. And we're excited about all these companies, but typically it's the higher yielding companies where you end up really compromising on growth. And one way we manage that balance is trying to make sure we've got as much as possible in names that are in that kind of 1 to 3 or 1 to 4% bucket where we're getting both of those things.
And finding, the last question on this balance between growth and income, do you think you sway one way or the other, or is it always a perfect balance, or do you think you tend to go more one way?
We don't sway. I think we lean, if push comes to shove and the choice is a stock which generates more income but where we're less excited about the growth, our bias is not to own that name very clearly. And if you sat in our discussions, you'd hear that again and again, like, yeah, okay, it might be giving us a 3 or 4% yield. How much conviction do we really have that it's going to be bigger in 5 or 10 years' time? Or are there big sustainability questions here that we haven't got satisfactory answers to? And we can come on to how we make those judgments. But very much we're leaning more on the growth and sustainability angles versus near-term income. So just to put some numbers on that, the yield of the fund is around 2%, which is, I think, 20% higher than the global market today. So it's a bit of an income premium. But if we wanted to emphasize income more, we'd push that much harder. But we think the risk of doing that is what that does to your long-term growth.
And talking about risks, where's your portfolio heading at the moment? Are you going a bit more cyclical after 2020, or what are your longer-term views in that sense?
We're not. So I talked earlier about how resilient the strategy was in 2020, and we don't. We think that resilience in times of stress is really valuable to long-term income investors, and we don't want to compromise that. And there's always an argument for saying, look, now's the time to get into riskier business models that showed themselves to be really challenged during a stress period. You should own them now for the rebound. So now you should be getting into airlines, into banks, into insurers, into back into the oil companies. That might work on a 1 to 2 year view, but we think that there's always another crisis around the corner, and the upside in those stocks is very often capped by when people remember the risks in the business model. So we and the other point I make is we've got plenty of exposure to the growth of the global economy within the fund. We own lots of very dynamic, exciting names. We don't need to load up on. We've got enough exposure to economic growth without investing in really flaky business models. Where we have been finding some more ideas of late, we have been finding more ideas in Asia. So over the last year, we've bought 2 Taiwanese companies, both of which are probably new to the audience. One is Silicon Motion. So they make a fascinating founder-owned business that makes the controllers for flash memory devices, this strange niche of semiconductors where they are the clear leader. A founder who's obsessed with NAND controllers, who's done a phenomenal job of building the business over the last 20 years. And another is a company called TCI. They make nutritional ingredients for health foods and collagen and things like that. And that's a company it owns the Chinese market and it's growing very rapidly into Europe and Asia. Again, a founder at the helm, really exciting growth opportunity. So we are finding new names that we think expose us to lots of growth, but it's not by buying bashed up cyclicals.
Obviously, there's a lot of income investors out there. Is it the kind of long-term lens that you take at Baillie Gifford that makes you different, or is it a number of things?
I think it's a couple of things. I think the time horizon, and I don't want to speak for our peers because there are many great managers out there, but I think if you sat inside our discussions, one thing that I think would genuinely be, or two things that would be genuinely different. One is the time horizon around which we talk. So whenever we're talking to companies, we're rarely asking about this year, or often we might talk about that to understand what's going on in the business today. But the bulk of our questions are really around, where are you heading over 5 or 10 years? So that, and when we're engaging with them, again, it's very much focused on, where are you going over the next 5 or 10 years? So I think that time horizon is one. And then I think the emphasis on the sustainability of the income stream in all its senses, so both resilience in times of stress, but also how confident can we be that this business model is robust to the challenges that are going to come from climate change, from rising consumer expectations, from workers' rights, all those things. I think the extent to which that's integrated into the process, I think is quite different.
And the investment world can be very short term a lot of the time. How do you make sure you are long-term investors when everyone, people can judge you on very short-term results?
It's a good question, and discipline is, I think, the heart of it. So I showed earlier the turnover numbers. We have the mindset of, we would rather take 2 years to get to know a company and then invest in it based on a fully rounded judgment than act on a whim. We typically have very clear investment cases, but then we give our companies years to build views on whether or not they're working out versus them. You'll almost never see us make a trading decision on the basis of short-term news. And because we're not planning to make short-term decisions based on it, that then drives the discussion, it drives the behaviors, it drives what you look at. But I think the other point is it's something that the team's got to do together. So you can only keep focused on the long term if everyone in the team is very clear about what the objective is. We're not trying to maximize the income stream this year. We're trying to find the stocks that are going to deliver the best outcome for 2025 and 2030. And maintaining that discipline in our discussions is really important. I don't know if that answers the question. It was a good question. I'm not sure it was a good answer.
And if there are worse years, how do you convince investors that this long-term conviction is the right place to be for them?
I think by being as transparent as we can be about what we are and aren't trying to do. So I would hope we try, we write all the quarterly letters ourselves. We try and be very transparent about how it is we're making decisions, how it is we're making judgments about what is and isn't a fit for our strategy. And then we try and be really consistent in what we do. I think, if, despite everything I'm saying to you, we were going out and loading up on businesses where there were big sustainability questions, or highly cyclical businesses which didn't fit with our stated ambitions, then I think we'd lose the trust of our investors. So we work very hard to be really clear on the process, and then make sure we're living up to that in practice, and try and be very clear about what we are and what we aren't.
I've got quite a simple question for you now. I think I probably know what you're going to say, but are you giving up performance for sustainability reasons?
It's not obvious that we are. And that this was, I said earlier, there was this question around, if do income investors need the full opportunity set open to them, or aren't you massively constraining your opportunity set if you can't own tobacco or things like that? I'll just share with you now. So So this just shows the performance numbers since inception, so just under 3 years ago. And it's delivered the strategy's delivered returns that are well ahead of both the MSCI index and also the peer group. And actually the returns have been slightly ahead of our sort of global income growth strategy as well. So having that responsible filter has not impacted returns. But the one area where I would say it does differ is it's got, I think having that responsible focus does lead to a slightly lower yield on the portfolio. So I said earlier, our yield on this fund is about 2%. Our global income growth strategy's yield is around 2.1% or something. So there is a slight that you do maybe give up a little bit of near-term income. You quite possibly get that back through growth over the long run. But it's not obvious to us that there is a trade-off. My marketing people will kill me as well if I don't point out the costs as well. At BG, we put a lot of emphasis on trying to share the benefits of scale with our clients, and we're really proud of the fact that it's got one of the lowest OCF figures in the industry.
So we've come on to sustainability. It's the Responsible Global Equity Income Fund. What does responsible investing mean to you?
Well, I tried to answer this a bit in when I was talking about the three pillars of sort of responsible investing as we see it. So one around sustainable growth opportunities. I could talk a bit about how we try and test that. Secondly, applying high standards to everything you own. So having a high minimum bar that companies have to get across or you won't invest in them. And then finally, being a responsible owner of businesses. So not pushing them to make bad decisions just for your, not pushing them to make bad decisions for the short term, but encouraging them to make good decisions for the long term. And increasingly our discussions with companies in that lens are focused around things like climate change or packaging in the case of some of our consumer goods companies. So how can we help companies address the long-term challenges in their business model? We put, I think, equal emphasis on all three parts of that. But I think one thing that has developed over the last 3 years that we've been managing the strategy is the framework that we use for testing what a responsible or sustainable business is. I think when we started it, we had quite if I'm honest, a relatively simplistic view. We had exclusions in there, and then we used the UN Global Compact as a kind of way of testing good business conduct. And we had questions in our process around the sustainability of the business model. But over time, with the input of Gavin Grant, we've got, I think, a lot more sophisticated in thinking about what does a sustainable business actually look like, and how should we make those trade-offs? And the framework we've developed is shown here, and we call it Impact, Ambition, and Trust. And basically, for every company, we're trying to form a judgment on each of those 3 points independently. So what do we mean by that? Well, impact, every business has externalities on the society at large. Sometimes those are very positive, and sometimes those are both positive and negative. And they come both from the company's products and also the company's operations. So we try and form a rounded view for every company of how material is this company's impact on society at large, and where exactly does that come? Where are the possible trade-offs or points of tension in its business model? So Nestle is one example here. Nestle is a company with a huge agricultural supply chain. It's got big global operations, so it has a substantial carbon footprint. There are questions around packaging for some of its products. So there are issues there that business has to engage with. A lot of sustainability analysis kind of stops there. And if you look at lots of third-party scores like MSCI, they are very incredibly granular at considering impact. But we think where they're often much less good is the forward-looking part around ambition. Because to our minds, having impact on your wider community doesn't necessarily mean you can't be a responsible business if your ambition to address that is really strong. And in Nestle's case, it's clear that they are determined to be a leader in their industry. We've had detailed conversations with management throughout the business on this. And to put some numbers around this year they're investing something like €1 billion or 1 billion Swiss francs in reducing their packaging footprint and addressing their greenhouse gas emissions. Sustainability is taken incredibly seriously in the company, and they've got really ambitious goals for where they want to be in 2030 that we think lead the industry. So to our minds, that thinking about that ambition, where a company's going, is vital, especially if you're going to be invested in the company for the next 5 or 10 years. The final part, which again, we don't think people put nearly enough emphasis on, is trust. So it's all very well having bold ambitions, but can you trust the people running this company? Can you trust the board? Are the ambitions credible or not? And in our case, there are plenty of companies greenwashing out there who will tell you, going to pick on oil companies again, but Shell's net zero ambitions, like, yeah, maybe, but there's an ambition there, but there's going to be a question over the credibility of it, and the amount of capital that's really sitting behind that. And so our judgment, we think the judgments on trust are really important. In Nestlé's case, it's a company where actually, when they set out to do something and they make a commitment, they deliver on it. And so that's a company where we're willing to back them that they will realize their ambitions. So that's the framework we're using. We're basically going through that process for every holding in the portfolio. And if companies have got a high impact and the ambition isn't good enough, or it's average, but they're not setting out to be a leader, then we're not going to own it, basically.
Mm. And you mentioned Gavin Grant a couple of times as he has the veto, the lead ESG analyst. How does that work in practice?
So it's based very much on this analysis. So Gavin's background's fascinating. He actually started off as an equity investor in Latin American markets 30 years ago, but then he spent much of the last 15 or 20 years at Norges Bank, and he was their head of engagement and active ownership for many years. And they were a pioneer in the responsible investment space. And he's very well recognized in the industry. So he does this analysis for every stock, and basically it's his call as to whether a company, as to how to view a company here and on this scale. And if he views it as having a material impact and insufficient ambition, or he's lost trust in the company, then he can say, we just shouldn't own this. One example, just to bring this to life, there's a Chinese furniture maker called Manhua, which has very little disclosure about how it manages its supply chain in practice. And we tried a number of times to engage with them on this and say, look, can you demonstrate to us that you're actually holding up really high standards in your supply chain, such that we can be confident that there isn't, child labor or anything in your supply chain or forced labor. We've got no reason to believe that there is, but they can't prove that there isn't. And their stated ambitions and what we believe their ambitions to be in terms of being an ESG leader in the industry are not high. And he, in the end, came to the view and said, look, this is a company where it's not just that they're Chinese. I just don't believe. I believe that there is a risk in the operations of this business, and the company isn't going far enough to demonstrate to my level of confidence that they're trying to address the challenges in the way that we expect. So that was one that we sold for the fund.
Mm. And ESG is often spoken about in terms of exclusions and engagement, and you kind of mentioned this already.
Yeah.
How do you, is that an example where there was engagement that ended up in exclusion, or how do you try and impact businesses' decisions?
Yeah, we're not trigger happy, and our bias is always to, and that's the point about having ambition in the scale, right? And we're trying to judge. There's always got to be a view on where the business is today. That's kind of in the impact judgment, but ambition is something that we can influence as stakeholders and shareholders in a company. And so there are some companies where we're saying, look, we think you should be more ambitious here. We're pushing them to be more ambitious in their climate change objectives, in their packaging objectives. And we'll give that process some time to see if we can get them to move in the direction we want. That would make us be able to say, look, be able to say to our clients, look, this is a genuine leader in its industry. But there's a time limit to that. We can't do that indefinitely if we're not seeing adequate signs of progress. And you know, over time, if companies, we will give companies some time, but if we can't get confidence that the direction of travel is fast enough or the level of commitment from executives is clear enough, then there'll come a point where Gavin's veto will kick in. And there'll be some examples that we'll be able to talk about later this year of where that's happening in practice.
I think we'll move on to our Q&A session in about 5 minutes or so. We've got a couple of questions in already, but just a reminder to everyone that send whatever you want over, and I'll try and ask as many as I can to Toby before we finish up today. So do pop your questions in the chat box. Toby, in your presentation earlier, did you say that it was all or a lot of your stocks that came from other Baillie Gifford funds?
It's about half.
Half,
so,
okay.
But here's the interesting thing: our overlap with any of the big global strategies that the audience will be familiar with, so Monks or Scottish Mortgage or anything like that, or the Positive Change Fund, the overlap with them, I don't think any of them is more than 10%. So what that tells you is we're getting ideas from our colleagues on the Japanese team or the European team or our smaller companies team, wherever it may be, and then we're putting them together in quite a different portfolio. The portfolio behaves in a very different way from those of our colleagues. It's less volatile. It's got a beta of 0.9. It's got very low overlap in terms of name overlap with the other global strategies, but we are able to rely on our colleagues around the floor for a really strong flow of ideas.
And you said there's about half that you own with share with other funds. Is the half that you don't, they tend to be the more income focused stocks, and it's the long-term growth that you kind of nick from elsewhere, or how does the kind of balance work?
Actually, it's a good one to go back to just the portfolio chart for. So there's shading on this chart that we didn't talk about much earlier. So you'll see that about 3/4 of the names on here are shaded light blue, and those are what we call sort of compounding machines. So they are established businesses with very long duration growth runways. We think they'll just keep on taking share of their markets for a very, very long time. Quite a few of those names are owned in other strategies, but where we tend to see very strong overlap with other strategies is the purple stocks, which are the exceptional revenue opportunities. So those are our really high growth companies. Those are about 15 to 20% of our portfolio, closer to 20% of our portfolio. And very often those names are ones that our colleagues elsewhere always also own. TCI, which I mentioned earlier, that's actually got a 3.5% yield. So it's not a low yield stock, but it's a very exciting growth business, and it's owned in our international smaller company strategy. Albemarle, the American lithium producer, is owned sort of in our Monks strategy, our global alpha strategy, because they, like us, are very excited about the potential for Albemarle to be one of the leading suppliers of lithium for lithium ion batteries for electric vehicles over the next 5 or 10 years. So there's quite a bit of overlap. Where sometimes we find ourselves on our own, it's not so much actually names with a high yield or anything like that. It's more stocks where the range of outcomes is a bit narrower, because our colleagues are very often looking for real asymmetry. And so one company, our biggest holding actually, is Novo Nordisk, the diabetes treatment company. That's a company where we've had lots of helpful input from our colleagues on other strategies as we've been building out our view on it. And we think it's really exciting because we think the core diabetes business is phenomenally strong. They've got a leading position, clear R&D leadership, some great new products. But the bit that really excited us was their treatments for obesity. They've got this really pioneering treatment that's delivered something like a 20% weight loss in 1/3 of the patients in the phase 3 trial. That's a total game changer for treating obesity, and it's a huge unmet need. So we're really excited about that opportunity. But we don't think the growth case here is ever going to be earnings up 5-fold. It's going to be extending the compounding runway for the next 10 or 15 years. It's that type of growth case. And that may appeal less to some of our colleagues who are looking for, where's the next 10x growth stock going to come from? So I think that the slight difference is less around what's the starting yield, and it's more around is it a compounder, or is it one of these stocks that could have a real hockey stick profile?
And I think before we move on to our Q&A, hopefully the poll pixie is alive and well, and we'll flash up a poll we have for our watchers today. A bit of audience engagement now, hopefully, if the poll will pop up on screen. Oh, there we go. So multiple choice there. Which of the following would you like to hear Toby talk about most? And then before we fly into the Q&A, we can have a little bit of audience direction on where we go over the last couple of minutes of the chat.
So that I don't skew it, I won't answer that question. She says, what's the easiest question to answer? But,
I'm going to answer it. What do I want to pick? Cool. Just give you 10 more seconds, and then we'll the poll pixie will fly up the answers on the screen, hopefully. There we go. It looks like we're going on to China then. So Toby, how are you thinking about regulatory risk in China?
So I think the starting point is, we think that for income investors with a long-term time horizon, China does represent a pretty massive opportunity. Here's a stat that many people don't know. There are something like 5,000 dividend-paying companies with a market cap of over £1 billion globally. 5,300 is the number. Of those, 140 are in the UK and 1,200 are in China. So something like 20% of the dividend-paying universe is in the China A-share market. That's a huge pool of companies, many of them run by founders. So there's a huge pool of potential ideas there for us to fish in, and we're starting to very carefully nibble at a couple of names there that we think are a fantastic fit for the strategy and got great long-term growth prospects. However, there's also a lot of risks there to be mindful of. There's the regulatory risks that are kind of front of mind at the moment. There's alignment questions around who you actually aligned with. Are you part of a state-owned company, and what are the pros and cons of that? What's the background of the founder that you're aligned with? Can they be trusted? So there's all sorts of questions that you've got to be very mindful of, and we've got a very thorough sort of due diligence process we go through. At the moment, what's clearly happening is that there is a redrawing of the lines around what is and isn't acceptable business conduct in China after a period for which the government's never been lax, but it's given the private sector quite a lot of freedom, and it's started to pull back on that and start to draw out some new limits around what constitutes responsible business conduct in China, much as regulators in Europe and the US have done over time, I might add. Now, by and large, we've got very little exposure to companies that have been exposed to that, but the one we have in the portfolio is NetEase, the gaming business. But you know, the changes that the government has made to the gaming industry are mostly around stopping children spending 4 hours a day playing games. That's going to have no impact on NetEase's revenues, and it's probably a very good thing for society and the gaming industry over the long run. So our portfolio hasn't been directly influenced really at all. There's a couple of opportunities there. So Hong Kong exchanges is a big holding for us. One thing that's happening is China is starting to pull capital back away from companies listing in New York and saying, actually, no, you should be listing closer to home, so in Hong Kong or China. So that's an opportunity for that business. But more generally, I think we're going to be very mindful about the extent to which new ideas are truly aligned with the long-term interests of Chinese society as the state perceives them. And it's unlikely that we'll be investing in companies where there's potentially a big conflict between what the state thinks is a desirable long-term business outcome and what the company needs in order to profit and succeed.
Cool. I've left this a bit late, so we've got a bit less than 10 minutes for the Q&A, so you have to be quite quick with your answers here, Toby. I see there's some stock specific questions, so I'll leave those to the end, and if we miss those, I don't think it's too much of a big deal, but they'll be answered afterwards by the Baillie Gifford team, I think, so the questions will be answered. Patrick says, given your emphasis on growth, is it not better just to take a modest percentage of the growth each year? I suppose that's instead of searching for income stocks specifically. Instead
of taking income. That's another way of doing it. We think you kind of get the best of both worlds in a strategy like this, in that you're getting a an income stream that you're getting, so you're not needing to worry about selling capital to meet your needs. You might choose to sell a bit more if you need to, but we don't think you're we don't think you're compromising your long-term capital returns by getting that income, and it means you don't need to worry about selling capital to generate income. I agree with the point of the question. If the question is, should I be trying to generate 4% income from an equity portfolio through natural income? I would say no, because you're really impacting your long-term growth. I think at the sort of level we're pitching the income stream, that there's a good balance there, and it's not compromising the long-term growth.
And Bruce has a question. It's quite a good job interview question, this one. He asked, what are the decisions that really worked and one that didn't work, and how did you learn from these?
So one decision that really worked, actually Novo Nordisk is one that has really worked for us. And one thing I've taken from that, when we bought it, the first thing that happened after we bought it was about 3 weeks later, the company had a profit warning. And immediately there was lots of soul searching and scratching our head around, have we completely misanalyzed this company? We commissioned some research from our investigative researcher to check whether there was something we got wrong with our diagnosis of the culture of the company. This is back sort of 4 or 5 years ago. But we stuck with it, and we did lots of additional research, and all of that came back actually with very reassuring, supportive answers. And the company addressed the short-term issues and has been doing exactly what we wanted, which is being on the front foot in innovation and pioneering R&D. And it's kept its focus on the long term, and we've stuck with it and kept adding to the holding as we've got more proof points through that our investment case was working. So that's one that's worked. It's become the biggest holding in the fund through a combination of performance, but also us adding to it. And it's been a very resilient dividend payer. So what do I take from that? Patience is really important. Have a clear investment case and then keep testing it and getting new inputs to that from different places. And then making sure you're aligned with companies that have taken a really long-term view. So that's one that's worked. One that hasn't, I mean, there have been several that haven't along the way. What's one that comes to mind? One that we're still thinking about was Hiscox. So Hiscox is the UK insurer. During the pandemic, they got caught out with business interruption losses, and they weren't able to pay out to some of their policyholders, and they cut the dividend for a year. We didn't see that coming at all. And it's made us think again about businesses where there's a lot of regulatory influence on the business and the dividend policy. Now that's one where, again, we're sticking with it actually, because we think the long-term growth prize is worth it. But we've definitely taken something from that example about regulatory risk, particularly around dividends.
Thanks for your honest answer, Toby, and great question, Bruce. We've had some great questions in so far. One from Dan is, what can you see as the biggest risk to your ESG funds, and how would you protect investors?
Great question. I think the biggest risk today is, I think it's actually around our consumer goods company. Well, yeah, one of them is around our consumer goods companies and whether they live up to society's expectations around packaging and the nutrition of the products. And we're doing a lot of work around that at the moment. There's a long meeting in the diary for tomorrow afternoon for us to go through all of our holdings again and say, are we confident that this company is genuinely positioning itself to be a leader in this industry and will keep ahead of the expectations of governments, regulators, society? And on the back of that, if we don't have that confidence, then we'll make changes to the fund, because we'll engage and we'll push hard, and we have been pushing hard to get those companies to be on the front foot. There has to come a point where you say, are we really confident this company is going to protect itself for the future or not? And if we're not, we'll move on.
I don't know if you have any thoughts on this specific stock, but Andrew asks, isn't a company like RDS transitioning to renewables and therefore responsible and improving ambition with potential growth on its share price and a recovering dividend, or are there more favourable companies in this arena?
Well, so on the specific one around, we've got an oil and gas exclusion on this fund. So that's one of the product-based exclusions. I'll just flash those up now so people are aware of what those are. And that was the exclusions were largely a function of what the investors in this fund from a large sample told us their minimum requirements were. So these aren't our philosophical beliefs so much as what we believe investors in a responsible income fund view as their bottom line. However, I would say that in the case of fossil fuels, that would make very little difference to the type of company that we would want to own for this strategy. Because if you go back to the Microsoft versus RWE example, what we're looking for is capital-light, cash-generative growth businesses that are in control of their destinies, not highly capital-intensive commodity producers where there's a major pivot in the business model needing to be made. I don't think it's wrong of Shell to try and make that pivot, or that they are a bad business because they're trying to pivot from one to the other, but we don't think it's well aligned for our strategy and what we're looking to do, because there's going to be a lot of pressure on the income stream as it goes from the old business model to the new one. And I actually spent some time as the firm's energy analyst, so I know these companies very well. And one observation I'd make is, and we've done quite a lot of thinking about this, the returns that they're going to make on their new business models are highly, highly uncertain. They've got very profitable legacy cores, at least in cash terms. And it's not clear how much of those core competencies they've got in the subsurface, in project engineering, the huge installed base they've got there. It's very unclear what, if any, of those transfer over to the businesses they're trying to build.
One quick last one, Toby. You've got about 30 seconds this one. I'm sorry, it's not very long. Isn't Coca Cola somewhat suspect in their use of sourcing water, especially in India? I don't know if you have any opinions on that. Fair enough.
There are questions around, for any of the consumer goods companies, there are questions around the operations, and the water one's a really good example of that. As I mentioned earlier, there's packaging questions that we've been engaging with them very robustly on. We'll be putting out our responsibility report soon that details our engagement there. And then there's also questions around the nutrition of the products. So the question we're trying to form a view on, I alluded to it earlier, is within that industry, which are the companies that are the leaders? Who's going to be on the front foot? Who can we be really confident is going to address the challenges? Nestle within that sector is one where I'd say categorically they are one of the leaders. Coke, we've got work that we're doing underway at the moment to test that assumption for Coke.
Brilliant. That's all we have time for today. Thank you for your questions, and thank you again, Toby, of course, for joining me today and for letting me and the folks at home grill you with all our questions. Before we close up, I should assure you that your CPD will be delivered tomorrow, so don't worry about that. And with the learning objectives are on screen.
Did we cover them?
We did, I think. Yeah, you helped us develop an understanding of the importance of considering sustainability when building portfolios. I don't think I need to read them all out. I think that's all good. I think everyone's happy that we've covered all of those. And before we sign off, let me just remind you of some of the dates for your diary of professional advisor events. In September, PA will be back on the road from the 13th to 23rd, taking a multi-asset masterclass around the country. We'll be going to Harrogate, Knutsford, Birmingham, Bristol, and London. You can find out more about that on the Professional Advisor website under the Events tab. There is another working lunch on the 28th of September, which is worth 2 hours of CPD, and it's a live one, so not online. We're actually in person, and that's at Alton Hall in Leeds. And then our big event, our flagship event, is on the 7th of October, PA 360 in London, where we'll bring together all the topics and debates key to financial advisors for a one-day festival of financial advice. And to finish off my bit of self-promotion, don't forget that the new Professional Advisor is launching on the 7th of September, Tuesday next week. You can join me and guests for a live broadcast at 1 p.m, including PFS President Sarah Lord, Postcard Planning's and NextGen's Rohan Sivajotti, and Nexus IFA CEO Kerry Nelson. So plug 1 p.m, 7th of September into your diaries and watch the show live on the Professional Advisor website. That's it for today's session. All that remains is for me to once again thank Toby for his presentation and for answering all of our questions. But of course, our biggest thanks go to you, our readers, for your company this lunchtime. I trust you found this helpful and worthwhile. If you did, then we'll look forward to seeing you again soon. Goodbye.